Hello everyone, my name is Ben Decker, and in this video I'm going to go over an introduction to pairs trading. So what are pairs trades and what are they used for? So there's two different reasons that I use pairs trades. The first is to hedge an underlying, like a stock or a future, and the second is used when I expect one underlying to outperform another. So one common pairs trade is gold and silver. So you might have heard of the gold-silver ratio, which is where you take the price of gold and divide it by the price of silver. These two underlines are highly correlated. They're about a 0.8 correlation, which means that about 80% of the time they both move in the same direction. So if gold goes up, there's a pretty good chance that silver will also go up. So it's used as a pairs trade often, so that's what I'm going to use today to kind of explain pairs trading. So I'm going to use the tastyworks platform here. So in tastyworks, if you go to the trade tab and then up in the trade mode, if you go to pairs, this pairs trade pops up. So we'll use gold and silver. I'm going to use the ETFs instead of the futures. The ETFs are much smaller products, so getting started with pairs trades, I would recommend the ETFs over the futures. So I'm just going to type in GLD here for the gold ETF, and silver is SLV. So I'll use those two. So you can see the prices here. Gold is 167 and SLV is 25.26. If you click this chart tab up here, it'll pop up as a chart, and this is gold minus silver. You can see that this is a downtrend, so that means that gold has been underperforming silver. If I want to switch it, so if right now this pairs trader, I'm buying gold and selling silver. If I want to switch it or swap it, I can click this. So now I'm buying silver and selling gold. And here you can see this is an uptrend. And this means that silver is outperforming gold. So whenever you're putting on a pairs trade and you are using a chart and you type in something minus something else, if you put on that trade, you're going to benefit if the chart goes up. So in this case, the chart is on an uptrend. If I think that trend is going to continue, I would put on this pairs trade where I buy silver and sell gold. And I'm hoping that silver continues to outperform gold. If I think this trend is going to reverse, then I would do the opposite here, where I would buy gold and sell silver. So here, silver is outperforming gold. I'm hoping that this chart turns around and gold starts to outperform silver. So I'm looking at these charts. I always want to put it on so that the chart goes up, and that's where I'm favoring it. So that's how to look at pairs trade chart. Next, I'm going to talk about how to determine how many shares of gold and how many shares of silver to use as a hedge. So there are three different ways you can determine how many shares of each underlying to put on for a pairs trade. The first way is going to be the cheapest, take the less amount of capital, and that's just to go 1-to-1. So there's one share of gold and one share of silver, and put that on. That's the first way of doing it. The second way is to put on the number of shares based on the buying power. So what I mean by that is basically the price of each underlying. So since gold is 167 and silver is 25.26, if you take 167 and divide it by 25, you get about 6.5 shares of silver for every one share of gold. So there you would do 1 share of gold and either 6 or 7 shares of silver. You could do 6 if you want to lean a little bit more heavily on gold, and you could do 7 if you want to lean a little bit heavier on silver. So if I do that chart here, you can see it's the same sort of shape. The notional value here is close to 0, and that's basically what you want here. So might do -7 if you want to get it closer to 0 notional value. That's another way of doing it. This is the way that I don't like to do. I prefer the 1-to-1 option over this option. The third way that I'm going to show you is the way that I actually do it, and that is doing the notional value in terms of the volatility of each underlying. Basically, what the volatility does is, or tells you, what the expected move is for each of those underlines. So on this pairs trade, there's this IV rank and IV index. So the IV index is based on the options pricing. What does the option market expect that underlying to move over a 1-year period? So over a 1-year period, the options market is pricing in a 19.1% move in gold and a 44.7% move in silver. So with this, if you did 1 gold and -7 silver, silver is going to move a lot more. So that'll mess with this, with how you expect it to hedge each other. So what I like to do, I'm going to pull up my calculator here. So you would take the price of gold and multiply it by the IV index. So I would take 167.01 times 19.1%, so 0.191, and that gives you 31.9. I'll do the same thing with silver. So I'll take 25.26 and I'll multiply it by 44.7. 0.447, and that gives you 11.2. So this tells you that instead of a 1-to-7 or a 1-to-6 ratio, that you should actually do about a 1-to-3 ratio. So in this case, I would do 1 share of gold and 3 shares of silver. And here's what that chart looks like. And if I was putting on this trade, I would go with the trend in this case. Like I said, if you think this chart's going to reverse and gold's going to start outperforming silver, then you'd put it on this way. But I would swap it where I'm buying 3 shares of silver and selling 1 share of gold, expecting this chart to continue in this direction. And the reason I'm doing that is the gold-silver ratio is near an all-time high, meaning that gold has outperformed silver for a very long time, over many years, and over the last couple months it started to reverse. So I'm hoping this trend continues for a little bit while. So as far as how much buying power this trade would use, so if I set this up with market close, it won't show me the buying power here. But on the gold side, it'll cost me $167 in cash, or about $90 in margin, and it'll cost me about $75 for silver. So 75 plus 167, that's about 240 bucks. So for this one pairs costs about 240 bucks. It's a good, easy way to figure out, it's a good way to see how pairs trades work, and get your feet wet without risking too much notional. So if you're using a different platform other than tastyworks, you might be asking, where do you find these IV indexes? So if I close out of here and just go into GLD, and if you go into the options chain Might be a little bit intimidating for those who don't use it often, but I have that up. So the gold is 19.1. I'm not sure exactly which or how they determine 19.1 here, but you can see the IVX here is the IV index. So for each of these expirations, this is the annualized percentage move that the options pricing is expecting. So, and I usually go between 30 and 60 days out. So about 19.2 to 19.3%. It's a little bit off from the 19.1 here, but it'll get you pretty close. So then if I do the same thing in silver SLV, you can see here 44.7. These are a little bit higher, 45.2 and 45.4. So that's an introductory to pairs trading. You can do this on any underlines that are correlated. So another one would be, for example, like Home Depot and Lowe's. You would expect those to be somewhat correlated. So if you wanted to get long, say Home Depot, but you didn't want to just flat out get long and hedge that position, you could get short Lowe's, so that it lowers the volatility of your portfolio and gives you a little bit of a smoother profit and loss in your portfolio. So that's an introductory. If you have questions, feel free to leave them in the comments. I can do a follow-up video if needed. Feel free to hit the like button and the subscribe button if you like these videos. I'll see you next time. Thanks.